So Steve, the last 2 months we've gotten together, the total return story in the closed-end fund market has been pretty negative. Was September more of the same?
It was. The closed-end fund market was down 2.5% in the month of September. That matched the performance of the S&P 500 and high-yield bonds generally. Those were the risk assets that underperformed. Higher quality fixed income was up about 70 basis points.
So Steve, from a historical standpoint, we're down a pretty significant amount year to date. Does this remind you of any period in the last few years?
Yeah, it certainly reminds me of 2008, 2009 in terms of the size of the losses. Just looking at equity closed-end funds, over half of equity closed-end funds are down more than 20% year to date. Off their highs. And looking at the fixed income market, which we'll put a different scale on that, but over half the fixed income funds are down more than 10% off their highs, total return. And that's a very sizable loss for a fixed income security. And so although we did see a lot of fixed income volatility in 2013, the fact that the credit markets are underperforming so significantly off their recent highs reminds me more of 2008, 2009. Certainly the magnitude of the NAV losses were much higher then, but the way the closed-end funds are pricing in fears reminds me a lot of 2008, 2009. And as we told our viewers, the discounts are reflecting that today.
And Steve, before we move on to discounts, 2013 was more about the fixed income side of the story. I get the feeling this year very few asset classes have been spared from the drawdown.
Definitely. The S&P 500 has been one of the leading equity markets, and the Barclays aggregate has done well from a fixed income side on a relative basis. But looking at the asset classes within the closed-end fund market, most fixed income funds have a corporate credit component. Spreads have widened out materially year to date. And on the equity side, there's a lot of diversification outside the S&P 500. You've got MLP funds that constitute about 20% of the equity closed-end fund market. Their NAVs are off 40% from the June levels. And so you're seeing pretty sizable NAV losses, and the performance of equity closed-end funds is certainly much worse than the S&P 500.
Steve, you referenced discounts a minute ago. When we last got together, discounts were approaching 10% from an all closed-end fund basis. Are we still kind of in that neighborhood after the end of September?
Yeah, the 10% number is still good. It started the month at 10 and ended right around there as well. We actually don't focus a lot on the average discount because we're looking at bottom-up opportunities. And we like to say that 1 in 5 closed-end funds today is trading at a 15% discount or greater.
Interesting. Steve, anything else on your mind outside of just total returns and discounts in the closed-end fund market?
I think the last time that people were as concerned about closed-end funds was 2008, 2009. And managing capital then, we had a lot of questions about the leverage of the underlying funds. And that's coming up again. Leverage is playing a role as net asset values are down. The leverage magnifies that loss. And a lot of investors are looking forward as well and saying, is there going to be potential for forced liquidations to meet leverage tests? And that certainly is possible and is actually occurring in the MLP market today. But for the most part, I think it's just important to step back and say, what kind of leverage profiles do most of these funds have? And, looking at the taxable bond market, 90% of those funds have some component of leverage. Munis, 95% of the muni funds are levered, and then about half the equity funds are levered. There's less leverage on the equity funds because the asset class is more volatile. Right. But looking at the average ratios, you're looking at about 30% leverage on most taxable funds, slightly higher on the munis, and again, on the equity side, it varies. These funds with utility exposure might have higher exposure or leverage ratios than something that's general equity exposure. And so those leverage ratios in and of themselves are not extraordinarily high, but closed-end funds must meet asset coverage ratio tests, and therefore forced deleveraging can occur when the markets move quickly. But we think that, when you think about that, we encourage closed-end fund investors to call their fund sponsors. That's certainly one of the most important issues that those sponsors are focusing on today. And I think it's important for a diligent investor to understand the leverage risks, understand how they're gaining that leverage, whether it's through preferreds or bank debts or repo, and understand the unique risks that might introduced to the return profile of the fund.
Steve, we talk a lot about returns and discounts in these monthly videos, but I'm assuming it's safe to say that the type of leverage and the amount of leverage is something your team looks at very closely as you look at closed-end funds that you own across the various strategies.
Definitely. Our background was lending to closed-end funds at one point, and so we have a very strong understanding of how closed-end funds are levered, and certainly have a view of what types of leverage are more advantageous than others when capital market volatility increases. And so we believe that was a competitive advantage that we had back in the financial crisis of 2008, 2009, and we certainly are spending we're always spending a lot of time analyzing the leverage profiles of the fund, but today it's one of the key components of an opportunity that we look at.
Steve, thanks as always for your time.
Thank you.